myself, Dominic Lombardi, and Francis Breeden. We're also joined by the SSC team, Michael Davidson, Claire Murdoch, and David Stone, who are on hand to help with any technical questions that we get in the session today. The plan for today is you'll shortly hear from Francis, who will talk you through some of the highlights of the report we published in December. And then we'll move to questions. And once again, we'll use Slido for that. And there is a link, a reference to that at the bottom for the Slido number, or you can click on the scan the QR code, and that will take you through to the Slido page. And really keen to get as many questions as possible from you. So as we're going through the presentation, if you have a question, please feel free to add it to the list, and then we'll do our best to get around as many questions as possible. We have an hour scheduled, and so we've got some quite good time to get through all the various questions that we'll have. So without further ado, I'll hand over to Francis, who will talk you through some of the highlights from the report in December. Over to you, Francis.
Thanks, Graham. Yeah, so as Graham said, it would be very much a highlights of what's going on, and so hopefully your questions will dig into the details. So to start with, just give an overview of where we end up on the funding situation for the Scottish Government. So here, the picture on resource funding is actually an improved one relative to our recent forecast. So you can see here we have an index showing you how the nominal increase in spending, that's the blue bars, goes up from 100 to 117, and there's also a real increase in resource funding to 208 by the end of our forecast, so an 8% increase over the forecast period. So that real increase is something that we didn't really have before, or certainly not to this extent. And so what I'm going to do really is give you a little bit of an overview in the rest of the slides where that came from, where that improved funding position comes from. But before doing that, I'll have a little look on the other side, which is the capital budget. So obviously what the resource budget goes on current goods and services and wages, capital budget on public infrastructure. And there the position is not so positive on funding, largely because UK funding to capital spending is going down, and therefore that translates through the block grant into reduced funding for Scotland. So as you can see, there's a real terms quite significant decrease in capital funding to Scotland. Okay, so that's the top line. So resource stronger, capital slightly weaker. Now let's see where some of that comes from. Particularly start with the economy. So as I'm sure all of you know, inflation is the issue of the economic issue of the day. You can see what we've done to our forecast for inflation compared to our last budget forecast. So you can see the yellow line was our December 22 forecast, where we had a pretty rapid decline in inflation, indeed down to zero in 2024. Now our current forecast is for a slower decline, but it's still a decline and still converging very much with the Bank of England's targets in the long run. So it's a relatively small change, but I think the key point here is that inflation is, for all forecasters, the really big uncertainty at the moment. Not only is there's a sort of long-running question about what the second round effects are from that burst of inflation we saw in 2022, 2023, through to wages and how persistent that can be. There's also, in the background, a lot of potentially strong inflationary forces that could come back again, and obviously energy being one that people are keeping their eye on. We are in the unusual situation of having a pretty tense political situation in the Middle East, but energy prices falling, and indeed even with the cold snap going on in the UK, gas prices continue to fall. So we're in a slightly odd situation where the data on energy is showing us falling inflation, but the risks are still very much for upside on that. So inflation remains a big uncertainty in everybody's forecasts at the moment. And one of the things you'll see a couple of slides on is that inflation is actually quite important for the Scottish budget position because fiscal drag, by the way that inflation not only raises earnings but pushes people into different tax bands, is an important part of that funding picture that I showed you at the beginning. Okay, the other part is looking at the sort of real situation, the real disposable income. And there, again, the picture is more positive. So you can see that our December 22 forecast in the yellow line had a very long wait until disposable incomes returned to their 2021-2022 level. Now we're seeing a more rapid recovery of disposable income, but again, not until 2025. So it's still not a very positive picture, but it is more positive than it was in our last forecast. And you can see that, in a sense, much of that recovery is really what we're seeing in the current data. It's not so much a forecasting choice as what's been coming through in recent data. You can see this solid blue part of the blue line is actual data now. You can see that's stronger than we expected. And we're also getting indications from sort of higher frequency data, particularly from tax data, that earnings are continuing to be strong through this year. So that's been a big background to our forecast, is that earnings growth is stronger than we had it in our last forecast. And that drives a lot of the funding stories I showed you at the beginning. Okay, let's look in more detail at that and see how the tax situation goes. So this chart is showing you the change in the income tax net position. Now, most of you probably know what net position is, but effectively what it is how much income tax Scotland is actually generating compared to how much it would have received if it was just done through the block grant. So what would have been done it without looking at Scottish income tax. It's a very sort of good summary statistic in the sense of how Scotland's position is relative to the rest of the UK. Okay, so let's look at that chart. So the top yellow part is where the net position was in December 22 in our last forecast, and that was a 700 million positive, i.e. that Scotland was generating 700 million more income tax than the block grant would have given. What you can see in the next two are those data changes that I've been talking about. So what has changed since December? Well, first of all, we have that 2021-22 outturn, which was more positive than we expected. So that's where that plus 322 comes from. And then we have this more high frequency, more up-to-date data, which is saying that strength in tax revenues and earnings is continuing into 2023, 2024, and that adds that other 346. So you can see there's a big boost in the net position coming through what we're seeing, particularly from earnings data. So much so that although the sort of headline of the budget is a big policy changes, those policy changes make a relatively small change to the net position, so plus 82, and that's because they come mainly from the higher tax bands where revenue generation is slightly lower. So overall, we end up with expected net position of about 1.4 billion, i.e. almost double what we expected it in December. So we're a much more positive position there. And as I said, that's really what coming through the data, what we're actually seeing in our outturns and other data we're looking at. Okay, so let's look a little bit at the tax situation across earners. And what this chart does is the yellow bars are the differences between the tax rates and those in Scotland compared to those in the UK that were already in place before this budget. And the blue bars are the changes due to the 2024-2025 budget. So as I said, so the 2024-25 budget, particularly more additions to tax paid by higher earners. But they add to a general increase in productivity of the Scottish tax system compared to the UK one that we've seen since devolution of income tax rates. Now, the other thing you can see very clearly, because of this fact that the lower income levels taxes in fact slightly have fallen, and the increase becomes higher and higher as you go up the income levels, is that inflation has a bigger effect on the Scottish tax revenue than it does on UK. That's to say that this fiscal drag, this people moving from one band to the other due to inflation, generates more income in Scotland than it does in the UK, and that's a sort of background part of what's going on in the Scottish versus the rest of the UK position. The high inflation that we're seeing and the stronger earnings growth we're seeing across the UK, but in Scotland, that higher earnings growth is generating more revenue as people move into different tax bands. Okay, to finish up with looking on the spending side or the social security side, which we look at. Again, we for some time have been forecasting a significant increase in Scottish social security spending compared to the block grant funding that would have come from the UK. So we're seeing a Scottish social security system that is spending significantly more than would have under the previous system, and that's for two reasons. First of all, there are some new benefits that the Scottish government has introduced. But secondly, and a little bit, in a sense, tricky area to forecast is that Scotland, Social Security Scotland, is committed to be, let's say, more customer friendly towards claimants, and therefore we are expecting a higher rate of not only applications but also of actual benefits being paid out as the system is being made easier for claimants to use. Now that, until recently, has been really a set of assumptions that we've made in our forecast. We've obviously tried to evidence them as much as we can, but clearly Social Security Scotland is a new enterprise and it's ongoing, and therefore we really had to make a relatively large number of sort of guesses about what we expect, how we expect Social Security Scotland to operate. In the final slide, I think I will show is that the data is certainly not contradicting our view of what will happen. So we're now beginning to see data of actual applications to Social Security Scotland, particularly for working age disability payment, which are the really big benefits. And you can see that, first of all, the grey line shows you England and Wales. And one thing you can see is there is across the UK an increase in applications for these payments. So there is that going on in the background. But you can also see for Scotland, where this benefit is being transferred to Social Security Scotland, you can see a significantly larger increase in applications in Scotland than you can see in England and Wales. And that's as we expected, because I think Social Security Scotland is really trying to make the application process easier for claimants, and therefore that's translated into a stronger demand for that benefit, as you would expect. Okay, so that's pretty much all I had. As I said, a very highlights package there of what we've done. So we will really look forward to your questions, and then to help you with that, then here's the slide showing you the link to Slido again. So it'd be very pleased if you could ask any questions you have about our forecast.
Great, excellent. Okay, thanks, Francis. So, there's the link to Slido, and if you put in your questions to that, then we'll come around as the questions, and we'll get us through as many as we can. So to kick us off, there's a question which is around one of the big things that came out from the report, or at least the pick-up and discussion afterwards, was around the issue of behavioural responses in income tax, and in part what we assume or what we estimate might be the behavioural impacts from the change in income tax, and how that then adjusts from the total revenue you might expect from a purely static effect. So maybe if I could come to David Ulf first, just to give a brief overview about, I guess, well, what do we mean by behavioural effects, and then how do we source the information in that, and how do they impact on the tax revenues that we forecast?
Okay, thank you. First of all, there are two types of drivers for behavioural effects that we've seen in the budget. There's the fiscal drag that Francis talked about in his presentation, but there's also been the introduction of the new tax band, the advanced tax rate band, and we looked specifically at the behavioural effects of that effect, and we showed that the static effect and the full effect were vastly different. the static effect was about 140 million, but once you allow for behavioral effects, that comes down to about 82 million in our forecast. So what are these behavioral effects? Well, there's two types of responses you can think about. One is the response of people who are taxpayers in Scotland. So they respond to changes in tax rates through, for example, deciding not to work so hard, not taking on so much overtime. For some people, there might be issues there as to whether they engage in elements of tax avoidance and tax evasion. But the other aspect of this is that there's a widening gap between the tax paid if you're a taxpayer in Scotland compared to if you're a taxpayer in the rest of the UK. So the question then might be, might you choose to decide to change your tax residence? Or for some people who may be, for example, own properties both in London and in Edinburgh, that might be a relatively easy decision to make. They just switch what they declare as being their tax base. For other people, it would actually involve a physical relocation of the family in order to take advantage of the somewhat lower taxes in the rest of the UK. So that would be a much bigger decision for them to take. And the way we try to measure these behavioral effects is through the idea of what we call taxable income elasticities. So what we look at is the effect of tax changes on the amount of taxable income that people declare. Now, for people who are Scottish taxpayers, the taxable income will go from one positive number, perhaps to a slightly smaller positive number. But if people change their tax base, then Scotland loses the entirety of the taxable income, and that transfers down to the Westminster. So you get very different effects depending on what type of response people are making. What we're calculating are population averages responses. So we're averaging the response across a whole range of different types of taxpayers. And in the literature, there's a lot of evidence about what these taxable income elasticities are. And because we might have some taxpayers for whom Scotland is losing 100% of the tax revenue, we tend to use taxable income elasticities which are towards the higher end of the range that are out there in the literature. And that gives us a quite significant response of taxpayers to any changes in tax rates. So that's why we were estimating such a large behavioural response to the introduction of this new tax band by the Scottish Government. So, David, do you want to add any more to that?
Thanks, David. I think David's covered an awful lot. Just going back to the question, which is what are the most important behavioral responses, and is there anything significant omitted? As David says, we're looking at population sort of responses here, and the literature, you know, what they're trying to do when they look at historic policy changes in other tax jurisdictions, it's really about trying to estimate what should tax revenues have been given the policy change on a static basis, and then what did they actually turn out to be. So they really, you know, and that's the difference is the behavioral response. They really capture all possible behavioral responses in the round. But then it's actually, the problem is that we don't know what the individual behavioral responses might be. We can't disentangle that into individual factors. But in terms of, you know, David mentioned a couple of the responses, things like migration behavior. But my suspicion is we don't have the data to necessarily back this up. It will be lots of people doing much smaller things like increasing your pension contributions after seeing an increase in tax rates is one way that people can sort of slightly change their behavior in quite a low cost way to reduce their overall tax bill. And another response, you know, it might be people might have been offered a job. It maybe pays £100 more per month, but after seeing the increase in taxes, you know, maybe they have to relocate, maybe it's just not worth the efforts at that point. So people might be less willing to stretch themselves for a promotion or a different job. So it's those sort of, you know, those relatively small behavioral responses in the grand scheme of things, but that could add up to a fairly big chunk of the behavioral response we see as well.
Okay, great.
Just
so,
if
yeah,
I
Domenico.
may add and follow up on what David Ulp and David Stone have just said. I just want to echo what they said, and also add that clearly behavioral effects mitigate the impact on revenues from recent tax changes. However, their impact is relatively smaller, somewhat smaller than a shift in the other variables we normally forecast, just to put things in perspective. Thank you.
Okay, great. Thanks, Domenico. So there's there's a set of questions around Social Security. So what I'll maybe try and do is come around through them and unpick some of the elements within there. And Michael, maybe you want to come in on some of the questions around that as well. So, because there's a few really interesting things that Francis kind of just highlighted, I think are really interesting around Social Security. So there's a question there about how do we see Social Security expenditure changing going forward, given an ageing population, and will this be a bigger issue in Scotland versus the rest of the UK? So maybe if I just kick off and maybe look to others to come in on that. I think, so there's a couple of really interesting things about what's happening to Social Security numbers that we highlight in the report. So the first thing is the significant rise in inflation that is coming through, that feeds through to higher Social Security expenditure. That's matched by a block grant adjustment, so there's additional funds that flow into that. A second thing that's really quite interesting as well is across the UK, and Michael might have some of the detail behind this, but what we're seeing across the UK is a significant rise in people moving into disability payments. So PIP in the rest of the UK, and adult disability payment in Scotland. We're seeing many more people flowing into these benefits post-pandemic than were there pre-pandemic. And again, all else being equal, that will feed through to a higher block grant adjustment, and that will lead to more funding coming through to Scotland. I think where the next bit comes in, which is the interesting bit from a public finance perspective about how it then hits the budget, is where there might be differences between Scotland and the rest of the UK. And that, as Francis said, is coming through our judgments about the changes to adult disability payment, child disability payment, about how they're essentially being operationalised, that we think will mean that the new system, the different type of system, the more supportive system in Scotland, will lead to a higher number of applications, more successful applications, and higher average payments over time. In addition to that, there are the payments that have no other comparative funding element in the rest of the UK, and that's things like the Scottish Child Payment. So there's a question here about the bit that then gets interesting over the longer term of where trends in Scotland relative to the rest of the UK may diverge. So because the system is different in Scotland, you'll have the same person relative to somewhere else in the UK, potentially more likely to receive the benefit in Scotland because of the new system. But then there's what happens to the trends and the underlying causes of people moving into these payments that potentially could differ between Scotland and the rest of the UK. And that gets into questions about the relative prevalence of disability over the longer term. Now, the way it works is that the block grant adjustment in the initial year essentially would protect Scotland, all else remaining equal, from having an older population at the starting point. But if there's a difference in the relative growth, which then feeds through to disability, that is a risk that the Scottish budget faces within that context. And just before coming to Michael, maybe for some thoughts, other commissioners, there's a question there about the kind of the issues that relate to benefits claims, inactivity, multifaceted and complex, and why don't we see a better understanding of this? I mean, it's a really fair point, but I think what we do is that what we're really interested in is the public finance element of it. We don't make a judgment call about whether or not a system is better than the other, or people moving into these, make a judgment call about people moving into these payments or moving out of it. What we're doing is simply looking at the, almost like the arithmetic in terms of what this means for the public finances. And that's where we make judgment calls that this different system in Scotland will lead to a different number of people claiming these benefits and getting a higher payment. And that's exactly what should be happening. That's exactly the policy objective of government, to put in place a different system. So maybe, I don't know if any commissioners get any thoughts, but maybe Michael, if I maybe come to you just to add some kind of bit more colour to that, and maybe David, you make quite a good point about the demand-led element of the payments as well. I'll maybe come to you for that if that's okay.
Yeah, so I can just pick up a couple of detailed points from these questions. So I think the first one, and it links into what Graham was saying, is around the high rate of adult disability payment applications, and whether is this going to be maintained or is it temporary because of people who've previously been denied PIP. And we think there will be some of it that's temporary. In our forecast we sort of think of what might have happened if PIP had continued in Scotland, and then what the additional applications are as a result of adult disability payment. And we think there will be sort of a lump over the first 18 months or so following launch, but then our expectation is that the number of additional applications, so the extra bit of adult disability payment compared to had PIP continued, will stabilize at a slightly lower level than it is now. But we still think that the overall process, there'll be sort of new people becoming eligible over time, and that the sort of steady state will be for a higher level of applications just to continue into future. And then the other point I see is just around the aging population. I think that's a really good point in terms of disability benefits, because they make up so much of devolved social security spending. Because you can think of the aging population of the amount of the size of the population that's over state pension age, and there's obviously spending in relation to that for pension age disability payment, but also sort of aging going on within the working age population that would be eligible to apply for adult disability payment as well. And both those are things that we sort of factor into our 5-year forecast. So the trends that we capture sort of capture that effect, but then sort of taking a step back and looking at comparison to the rest of the UK, I think that aging is something that's happening similarly across the UK as well. So what will happen is that if there's an effect from the population aging in England and Wales that increases benefit expenditure there, that will then sort of flow through to increases in the block grant, so additional funding for the Scottish Government. So if there's sort of similar sort of aging in both Scotland and the rest of the UK, then there will be some additional funding that would support the additional spending in Scotland. But where there's additional spending because of the changes made by the Scottish Government, there's potentially still a bit more of a risk on the Scotland side with that aging. But I'll stop there, and I think David's going to come in now.
Yeah. Okay, there were 3 points I wanted to make here. Just in addition to what Michael was saying about some of the drivers of the increases in social security spending, a factor that's been identified by the OBR as operating at the UK level, and we think is also operating in Scotland, has been the impact of the increase in the cost of living, driven by the high inflation rates that Francis was talking about in his presentation. And we think that could be having an impact on the claims for disability, essentially through 2 channels. One is that the increase in the cost of living will create some mental health problems for people. Mental health, we know now, is a major driver of disability benefit claims. But the other is just that people may decide that, given that there might be some costs of claiming Social Security, the pressures coming from the cost of living make it worthwhile making that claim. And so more people will be claiming for that reason. And the thing that's significant about that is that once they've made the claim, if the cost of living pressures ease off, they're still going to be on the benefits. And what the OBR is forecasting is that as inflation comes down, as Francis was saying in his presentation, as cost of living pressures ease, that will reduce the rate of increase in the claims for disability benefit. It won't reduce the numbers of people on disability benefit. And that brings me to my other point about that Graham was mentioning about the demand-led nature of Social Security spending. Social Security spending, the government decides at quite a detailed level what are the criteria that people should satisfy in order to be eligible for certain levels of benefit. And that then gets implemented by Social Security Scotland when they're faced by people making claims. They implement those rules. And the Scottish Government also determines in detail the amount of money that goes to people in different categories of disability. So Social Security is all the details which are being determined by the government. What the government doesn't determine is the total amount of money that's spent on Social Security, because that depends on the number of people who decide to claim. And as I mentioned before, people have a decision as to whether or not to claim. It depends on how that claim is assessed by Social Security Scotland. And it then depends on how long they stay on the benefits once the benefit has been awarded. And the government doesn't get to control those numbers. Once it's set the policies, they are just duty bound to pay the money out to people. And so the total amount of money spent on Social Security is not under the control of the government in quite the same way that education and health spending is. The Scottish Government can just decide this is what we're spending on health, and that's it. All the detailed consequences of that are determined by lots of other people, but they determine the total amount. In Social Security, it's almost the other way round. They determine the detail of who gets what, under what conditions, but the total amount of money is somewhat outside their control. And that's what makes Social Security a very different type of spending from other areas of government spending.
Thanks, David, Michael. And I think the one thing that strikes me around the Social Security and the overall outlook is actually a UK-wide effect that we're seeing in the data, which is, as I mentioned, these really significant inflows of people into disability payments driven by issues around mental health and potentially long COVID and other concerns. And a lot of the time, understandably, when we're looking at it from a budget perspective and a public finance perspective, we're looking at what's the expenditure on that, when actually the big fundamental question is what is leading in the economy or society to these large numbers of people flowing into these payments. So what is happening to society that's leading to these negative situations, people that are leading through to really quite difficult situations, which means they're having to access these benefits. And that Paul Johnson's been talking about this in the IFS about it's one of the big things that's happening in the UK public finances that really we're not really talking about too much, or we haven't really looked into the detail of that. And we really do need to understand that. So it's the kind of upstream effect of this and with the consequences of that I think are the most important questions for us to be asking. There's a question here about Scottish Government pay policy, and did the Scottish Government give us a pay policy, and is that a risk to the forecasting process and the like? So essentially, we have a protocol with the Scottish Government that is to give us information on things like policy choices and the like, and in there's a request for us to be given a pay policy by the Scottish Government, and that helps us do essentially when we're coming to our forecasts around tax, economy moving and the like. What we don't really have an interest in is essentially the detailed intricacies of that pay policy and how that's then shared within portfolios and the like. Our main ask is to see what might happen to the totality of the impact on the economy and potentially through to revenues. So as part of that protocol, the government should give us a pay policy. Obviously, if pay policy negotiations are still going on, then that might not be possible. So the government didn't give us an exact finalised pay policy. So essentially what we then do is we make our judgment call about what we think is a reasonable assumption projection about what a pay policy might look like. Of course, that's not saying that's what pay policy will be. It's up to the government to then negotiate with unions and agree splits within that. But from an economy-wide moving perspective, we put through an overall judgment about what we think will be the broad trend in pay policy. And what we did for that is that with inflation, CPI inflation of 3%, We essentially use that as an overall increase in public sector pay. That then feeds through to a total increase in the pay bill of 4.5% once you include for progression. And that's essentially what we use as the forecast for public sector pay into the budget. And clearly government will have to finalise the exact intricacies of the pay policy. I think the thing that's interesting in that context, and I think is quite important when you're looking at it in terms of what the implications of this will be, is that pay around about half, just over half of the total resource budget from the Scottish Government is essentially on pay. So you can see the difficult choices that government is going to have over the coming months about what it does around pay in the context of, if the total resource budget is going up by 3.5%, if your pay bill is half of your resource budget and it's going up by more than that, that means everything else that you're spending money on has to go up by less. So in other words, it has to go up by less than a real terms increase relative to CPI. And that's where the really difficult, balancing act for government is. On the one hand, you've got pay. On the other hand, you've got the level of totality of public sector employment. And then you've finally got what you actually can spend on public services. And with a tight budget settlement, the more you put into pay awards, that has to be found from relative savings or relatively less growth in employment and delivery of services. Or if you put more into delivery of services or protecting employment, that means you get less funding to generate into higher levels of public sector pay. And that's just a really difficult situation that government has when you've got a really tight budget settlement. So that's where we got to on public sector pay. There was quite a bit of discussion about this when we appeared in front of the Finance Committee. So there's a good transcript there where Michael Mara was asking us some questions where we set it all out. And we do discuss in the report what we do on public sector pay. Within that context, there's then a next question, which is probably one really good to get Claire's reflections on, if that's okay, just around the outlook for spending and resource and capital compared with England. And Francis has spoken a bit about the block grant for capital, but maybe, Claire, if you could maybe broaden it out to give a reflection on how the outlook is compared to England, but also it'd be really good to get some reflections of the discussion that we had in the report about what's driving the uplift in the budget over the next few years, and then the balance of risk between the block grant and what our judgment is that the block grant could look like, but then also what our judgment is of what the net tax position could look like, and just unpick that. That'd be really helpful.
Thanks, Graham. Yeah, it's a great question, because we don't draw that comparison out directly in our report, but it's obviously something which will have a big effect on the Scottish Government's funding. So the block grant is still a really important component of how much the Scottish Government receives, and that's directly related to UK government spending in devolved areas, predominantly in England. So where the UK government is spending more on health, for example, that results in additional funding for the Scottish Government. There's also obviously not the only thing that is now determines how much the Scottish Government have to spend. There's also tax revenues. So those are sort of the two biggest areas, particularly on resource, where we're seeing two quite different trends. So the block grant, which is the UK government funding, is actually looking pretty flat across the next 5 years. And that's predominantly based on UK government spending plans at the moment. And the OBR have highlighted in their recent reports how the UK government typically increases spending as you approach the end of a spending review period. We also know that we have a general election taking place in the next year at some point. And the UK government may choose to increase spending in advance of the election or after the election. And that would result in additional funding for the Scottish Government. So there is quite a lot of uncertainty about UK government funding for the Scottish Government over the next 5 years in particular. And that applies to both resource and capital. And you can see that, as Francis said, the outlook's looking pretty different. So resource, we have some real terms growth happening over the next 5 years, but the outlook for capital is a shrinking capital budget, particularly in real terms. That's largely pretty much all driven by the UK government, but it's also driven by a slight reduction in Scottish Government borrowing plans over the next 5 years. coming back to resource, sorry, I'm jumping around a little bit here, but coming back to resource, the real thing that's resulting in increased growth in the resource budget over the next 5 years is the net tax position, which is higher income tax revenues in particular. And we've spoken about fiscal drag, more people being pulled into paying higher tax rates, and the structure of the tax system in Scotland means that that is almost sort of more tax rich in Scotland than it is in the rest of the UK. So that is looking positive for the Scottish budget, but there is uncertainty around that and what happens to both inflation and wage growth, but also in particular what happens to wage growth in Scotland versus the rest of the UK will be a really important factor here. And my colleagues will be able to say more on this than I can, but we're looking at just slight differences between our forecast and the OBR's forecast can actually have quite big effects on the potential for the net tax position over that 5 years. So there's always going to be uncertainty, but when you're dealing with pretty high growth rates in earnings at the moment, that sort of increases that level of uncertainty that we have.
Great, excellent, thanks, Claire. Okay, so there's a couple of questions. Sorry, David, do you want to come in? Yep.
Could I maybe just add to
Yes.
that point that Claire was making? We've done a calculation of two stylized facts. So one is that because Scotland has a pretty progressive tax system, for every 1% by which earnings in Scotland grow faster than earnings in the UK as a whole, the net tax position in Scotland grows by 250 million. But also because Scotland has a more progressive tax system than in the rest of the UK, for every 1% by which growth in earnings in Scotland increases, then net income tax position improves by 25 million. So these are the kind of drivers behind the factors that Claire was talking about, which are driving up the net and improving the net tax position in Scotland.
Great, thanks, David. That's really helpful. So there's a couple of questions on capital spending. One around the Scottish government's stated plans around bonds for infrastructure, and then also something maybe on the links between capital spending and the economy. So maybe for the second question, if it's okay, I'll come to Francis and Domenico just around the links between capital spending and the economy. On the specific question around Scottish government bonds for infrastructure and the like. So the first point to make is that the Scottish government has a capital borrowing limit, and what doesn't matter is whether they issue bonds themselves or go to a commercial loan or actually go to the National Loans Fund, so essentially borrowing from the UK. So the fact that they might choose to go to issue their own bonds in the future doesn't really add any additional capital budget headroom, because you've got this limit, and that is the totality of it there. And we talk a bit about what the outlook for that capital limit looks like. In many ways, one good thing with the fiscal framework review is that it's essentially going to lift that limit in line with inflation, so it's not as constraining as it was before. And so that means that the budget, the limit that the government can do on the capital borrowing will go up, but but the fact that they issue a bond won't help them in that regard. So we don't have the detail yet on the government's overall thinking around bonds, etc. That's something that we're waiting on, which we think we'll have probably more to say when we come to the medium term financial statement in spring, and we'll know a bit more about their plans there. Clearly, there'll be assessments there around affordability, around potential interest rates, around the type of product, greater flexibility is what it will look like, but we'll just need more detail on that before we comment. But it doesn't open up a new source of additional funding. It's just potentially a different way of funding it and potentially some more flexibilities in there. But maybe Francis and Domenico, if I come to you, just some general reflections about the links between the capital budget and the economy.
Yeah, no, it's a really important issue, and it's become a big important issue in the UK, in the sense that I think this budget, for the UK side of the budget, has been there's a lot of comment about this fall in capital budget that's in that, and indeed the OBR have really said that they have some concerns about the scale of the capital budget. So UK capital budget falling well below 3% of GDP when the OECD average is getting on for 3.5%. So I think there's a concern that has an impact. And I think most economists would agree that will tend to have an impact on long-term growth. That clearly you can waste your capital budget, but there's an awful lot of good things you can do with your capital budget that will promote growth. So I think there is a concern that this lower level of capital spending is going to have a longer-term effect on growth. Although over the sort of horizons that we forecast, that effect is relatively small. This is more of an issue for the sort of 10, 20-year out forecasts than for the sort of horizons that we focus on.
Domenico?
Yeah, thanks, Graham. Let me echo what Francis just said. Clearly, capital spending is very much related to longer-term sources of growth. And what we know is that trend growth in Scotland, which we currently foresee at about in a range between 1 and 1.2%, is lower than it was, say, in the decade between 2000 and 2010, and is clearly lower than other parts of the UK. So clearly, whenever we talk about budget policies, we tend to focus a lot on the shorter term, what is going to be happening, say, in the next year, in the next fiscal year, in the next few fiscal years. But still, this is a very important issue for the broader picture in the longer term. And then, regarding the bond financing, clearly this is a way of one of the possible ways to fund your capital spending is not perhaps in line with international practice. And as soon as we'll have more details, we'll certainly be in a position to make a better assessment.
Right, thanks, Domenico. So there's a really good question there. Again, maybe if I can come to Michael first of all for the technical aspect of it, and then open it up to commissions as well around the backlogs in mental health care and NHS and how that's potentially feeding through to disability payments. And then maybe Michael, if you could maybe expand that to talk about the stuff we've been thinking around cost of living, and just expand on that and how we model the various inflows.
Sure, yeah. So, yeah, I think it's definitely a factor that we've considered. And I think when we first sort of identified this trend and seeing a rise in the number of applications for disability benefits, both in Scotland and across the UK, I think we identified the rise in sort of mental health conditions and then sort of delays to NHS treatment as being a possible reason, alongside the cost of living, which has sort of led to people seeking additional sources of income. And I think we still think those are sort of reasons that are driving this increase. But our thinking maybe has developed slightly, I think, and it's worth saying that just we now put maybe a bit more weight on the cost of living crisis in that, so that then I think, as David's already said, there's this trend that's increasing, but then some of that sort of additional inflows to disability payments we expect to ease a bit as the cost of living crisis eases. But I think it's quite difficult because we're still in the early stages, even though it's something that we identified last December. I think it's still something where we're in the early stages of looking at data coming through. It's also something that the OBR has been looking at in detail, and I think in there they published the Fiscal Risks paper last summer, which looked at, in particular, around increases in ill health, and we've looked at it primarily from the aspect of disability payments, primarily adult disability payment, which people who are both in work and out of work can receive. There's no income related element to getting that. Whereas the OBR has broader remit, so looked at also at ill health benefits for people out of work, and they've got a bit more of a detailed discussion in there if anyone's interested in going and having a look. And in that they referenced the some of the waiting lists in the NHS across the UK as well.
Graham, if I may,
Yep.
if I may chime in, I would also add that clearly some of these social security payments, they do interact with the cost of living crisis that was particularly sharp at the time of the pandemic. But there is also a more of a longer sort of more of a trend in that, because mental health issues in our societies are becoming less of a stigma. And in other words, people tend to come forward and sort of, disclose this disability and, of course, try to apply for related benefits. This is a little bit difficult maybe to model, but nonetheless, it is one of the trends that we are observing, in our societies.
Okay, yeah, thanks,
Graham,
Domenico.
could I just
sorry,
add
David,
2
on you
points?
go.
Could I just add 2 points in relation to delays in payment? One is that once an individual has launched a claim, once that claim is approved, they will get their pay backdated to the start of the claim for the award. Of course, that doesn't mean that the delays having no effect on them. But from our point of view, in terms of the total amount of pay that's actually being paid out, that doesn't really change very much because of the change in delays in payment. The other point to make is that one of the factors we heard in talking to Social Security Scotland that is behind some of these delays, by no means all of them, is that one of the factors that the Scottish Government has done in reforming the delivery of Social Security is to allow people to bring a much wider range of information to bear on their claims for disability payments. And people were turning up saying, we assumed you had all this information. And they were told by the Scottish Government, no, we don't actually hold all this information. You have to go out there and find it yourself and assemble it. So that might be one of the factors in some of the cases. That's why there's a delay in payment. People assumed that the government had all this wide range of information instantly available, and it just wasn't instantly available. They had to go out and collect it themselves.
Okay, great. Thanks, David. So there's a question here about kind of future outlook around tax revenues, both in terms of new taxes, but also in terms of further tax raising measures in there. Just before I just kick off on that and come to them, there's a specific question there which I'm conscious it was asked a long time ago, is about why we don't look at, or there's not been a discussion around the impact of the fiscal outlook budget on the voluntary sector, and why not? So just be clear on that. So we don't look at any sector in particular when we do our forecasts, because essentially we're looking at the macro picture overall. What we're increasingly doing, and we have a paper coming out next week where we're starting to look at a bigger deep dive into the spending components. And then from in there, you can start to see about where particular budget allocations are going, what allocations are going up, what pressures are going down, and the like. But we don't comment as a rule on specific impacts on sectors per se. But that new work that we're doing around the spending profile, as we continue to develop that, will be the areas where you can see where there's particular parts of the budget that might be under greater pressure than other ones. I mean, just on the broader question there around, so the question around tax raising measures and the like, and the impacts in that. And just one thing before I open it up to some quick reflections, it'll probably have to be the last question we've got, but there's a really interesting figure in the report, figure 2.7, where what we do is we look at the resource budget, but then strip out the commitments that government have to make on things like non-domestic rates, but also social security. And there you see that the total resource budget is actually going down next year in real terms, and then remaining really quite constrained over the outlook there. So that then just shows you, I guess, the overall pressure that the overall budget has got in there, which then means that you get into questions like what happens to revenue going forward and what the government might do. As Francis said in his presentation, the government are actually raising quite a lot now relative to what would be the case if they'd implemented the UK policy, both through the freezing of the thresholds and income tax, but also these additional rates, and that will grow as the period goes forward. It's then really a policy choice what more government might do and what they might do on the taxes that are devolved. And there's also lots of talk about wealth taxes and similar things, but that's really something which would be gets into a broader discussion about the fiscal framework and potentially new tax powers and negotiations that might come down the line. So essentially the government have really got to focus on the tax powers that they have at the moment, or look at other options around local taxation. And I don't know whether anyone wants to add anything to that.
I did just come back on this thing about
the
voluntary sectors. I think it is a really important point that, you know, economists obviously we focus on GDP and all these money numbers, but actually economic well-being is much wider than that, and the voluntary sector is an important contributor to economic well-being. I'd say in our defence, we are very much a money organisation. We are the budget overseers. We're interested in taxes and spending, and the voluntary sector doesn't have so much direct impact on our work. But I think the point is well made that there is sort of non-monetary contributions to the economy are very important, and sometimes get lost in these discussions of how much revenue, etc., is being generated.
Yeah, great. Thanks, Francis. That's a really important point. Okay, I think we've managed to get around pretty much all the questions, and I want to make sure we finish on time. So first of all, can I just thank the commissioners and the commission team for joining the session today and for helping to answer all the various questions, and thanks very much to the audience for joining us in this webinar. Just before we go, a couple of quick updates on things to watch out for from us. So on Monday, we'll be publishing a short paper, as I mentioned, looking at the Scottish Government spending plans. Rather than portfolios, it's something called the COFOG, the classification of the function of government, and that's a really good way of presenting things, because it essentially captures what the money is actually being spent on things like health and education and the like. And we're also providing a bit more update on the 2024-2025 position relative to previous years, so you can track a bit more about what's happening to the overall spending elements. And there was a question about the NHS in there, and that will give you a bit more of an idea about what's happening to that over time. And so that'll be coming out next week. You know now we're doing a lot more work into fiscal sustainability, so we'll have our next fiscal sustainability report coming out in March, and that's going to have a particular look around climate change and the links between climate change and fiscal sustainability, looking at the links that go there, and that follows our work on demographics that we did last year. And then finally, we've got our next set of forecasts, which will come around soon enough. They'll be coming around in May when the government publish the medium-term financial strategy, and we will pre-announce when we're going to publish all of that in advance. And for keeping up to date with everything that you can do, you can join us on the mailing list, which you can sign up to on the website, and we put everything out on social media in advance as well. So please do give us a follow, and you can find out what we've got planned and coming down the line. So can I just thank everyone once again for joining us. Your interest in the work of the Commission is hugely appreciated, and I wish you a pleasant rest of the day. Bye now.
Thank you.